Hi, my name is Marco Byrne, the Research Director of GoldCore.com, your precious metal storage specialist since 2003. And I'm bringing you a market update today. I think it's timely. There's a lot of important developments in the gold market, a lot of short-term issues to be looked at. So I'm going to look at that. I'm going to look then at the long-term outlook and the possibility of gold over $16,000 per ounce and silver over $770 per ounce. I hear people gasp in dismay when I say those figures, and I'll qualify that obviously. And then most importantly, I'm going to look at the real reasons why you should own precious metals. And it's not about price. Price is what you pay and value is what you get, as Warren Buffett said about investing, which is even more appropriate when it comes to the precious metals. So yeah, we're going to get straight into it. I'm going to look at some of the recent developments in the gold market, because there's quite a lot of things happening, quite important things, and mostly very bullish things for both gold and silver. Very positive indeed. The developments, there's very few negative developments that would make you concerned about the outlook. There is a degree of being overbought in the very short term, which I spoke about recently on Bloomberg TV, and since then gold prices have come back a small bit. But in general, let's just look at anyway some of the recent developments. So you should be able to see my screen there, which is showing our news.goldcore.com page, which is where we put the daily market update, the award-winning daily market update, which we've done since 2004. So, I mean, just overnight interesting developments. We'll just look at the very short term. Gold came off $30 yesterday on the COMEX, selling in the futures market. 2 hours of selling after the European and London markets were closed. There was no apparent catalyst whatsoever, and robust global demand for gold being seen by bullion dealers, government mints, refineries, all the people we speak to on a daily basis, and indeed an even bigger indicator of the strong global demand for gold is the world's largest gold ETF, the SPD, or the Spider Gold ETF, trading on the New York Stock Exchange. They had a very significant increase in their gold holdings on Wednesday. So just yesterday as well, they rose 1.8% to 924.94 tons. So that's quite a significant amount of tonnage in one day. And that's for one gold ETF. Admittedly, it's the biggest gold ETF, but it's just one gold ETF, and gold ETFs around the world are seeing inflows, given the very significant macroeconomic and monetary risks that are building in the system. So just to look very briefly, if you divide that, I should have done this beforehand, but I'm curious to. So yeah, it's around 16.65 metric tons went into that one gold ETF in one day. So I think that should have been a catalyst for higher prices, not lower prices. But there's a wider story about that. And so we cover that today in the daily market update, which you can sign up for on GoldCore.com, and you can see that that's a very interesting a gold chart there, a 3-day gold chart from our friends in goldprice.org, and you can see the sell-off in red there yesterday. So yeah, quite a big sell-off, $30 as I said in the 2 hours. But meanwhile, the smart money continues to diversify into gold. Everyone from the biggest hedge fund manager in the world, the likes of Ray Dalio, to the oldest money in the world, the Rothschilds, who have talked about this being a gigantic monetary experiment that we're engaged in, and it's not going to end well, as most Ponzi schemes don't end well. And this, our current fiat monetary system and the quantitative easing and negative interest rates, we've about $17 trillion of government bonds internationally, which actually have negative interest rates now, which means that gold is now a higher yielding asset versus other so-called safe haven assets in the form of government bonds. So it's a very bullish backdrop, and the smart money is diversifying into gold. It's as simple as that, and the prudent money is actually moving out of gold ETFs and out of digital forms of gold and unallocated forms of gold and paper and digital gold, and they're moving to the safety of fully segregated gold coin and bar ownership, and that's obviously what we provide. We're one of the few gold brokers in the world to actually provide that. So Yeah, so that's interesting, and it comes on the back of just recent days. There's a lot of bullish developments. Obviously, the what happened in the Middle East at the weekend in terms of Saudi Arabia and the attacks on the oil refinery there, and oil prices surging 10% in a matter of hours, and gold prices and silver prices reacted instantaneously, and stocks came off. There's also the President of the United States of America, Mr. Donald J. Trump, came out and basically called he's called the Federal Reserve and the senior officials in the Federal Reserve boneheads, and he went further than that last week, and he said that they had failed again. They have no guts, they have no sense, they have no vision, and they are terrible communicators. And Jay Powell, the actually head of the Federal Reserve, he said, is a terrible communicator. So this is the President of the United States of America attacking the people who are basically meant to protect the value of the dollar and to help the U.S. economy, and basically, he basically called them boneheads, So that right there, as we said, we felt that should have resulted in gold prices going up $100 on that alone, and not actually going down. There's also the JP Morgan news, which is very big. The Justice Department. Basically, the accusations that JP Morgan are a criminal enterprise, and after the $30 sell-off yesterday on no bad or no negative gold news, you'd wonder if this criminal enterprise are continuing, because there still seems to be shenanigans going on in the gold futures market, as we saw yesterday. So you'd wonder, has a whole lot changed, and are other players now manipulating the gold market? Potentially, but as we know, has happened between 2001 and 2011, 2012, manipulation can only last for so long. Ultimately, the forces of supply and demand will dictate the price of gold and silver, and it can be quite effective in the short term, and it can manage the music, and it can affect sentiment, So more importantly, is the monetary backdrop. This talk now that we're, rather than quantitative tightening, we're going to quantitative easing, we're going to negative interest rates. The ECB is now doing QE of 20 billion euros a month, and they've gone to minus 0.5% interest rate, and the Fed is also talking about going to negative interest rates. So that's very, very, very bullish for gold, and will be seen as such, So that's all the sort of recent short-term. Yeah, banks internationally, Citigroup are talking about gold at over $2,000 per ounce. JP Morgan, Goldman Sachs, all the banks have revised higher their gold price outlooks, understandably so. They're a bit slow, and they were behind the curve a year ago. They should have realized that all these fundamental factors were very positive for gold, but better late than never, I suppose. And here's Ray Dalio, who we just mentioned, talked about protecting oneself from a paradigm shift akin to the 1930s. So, and he's basically talking about the disparity of wealth in the world, and the fact that the amount of debt in the world is so astronomical, estimations of 250 trillion plus of global debt, that the central banks are now going to become ineffective, that they've used all their ammunition, and even if they go to negative interest rates, or even if they go to quantitative easing of 50 trillion, 60 trillion, and electronically create trillions and trillions of dollars, euros, and pounds to buy their government bonds and artificially suppress the interest rates, that he's saying he doesn't think it's going to be effective, and he's a highly respected analyst, and he takes a long-term historical perspective. He did an excellent article which we covered on LinkedIn, which is well worth a read. So gold's hitting record prices. It hit record prices in near all-time record highs in Japan, nominal record high in Japan. The highest has been in Japanese yen, one of the stronger currencies in the world since 1980. It's also going there in Australian dollars, all the rest. So the outlook, both short-term and medium-term, the outlook is bullish, but it's bullish, but in the very short term, it does look technically slightly overvalued from a trading perspective. And I said that on Bloomberg recently, and I got attacked by Goldbug saying, "How dare you say this? And you're anti-gold and blah blah." blah, blah. And, you know, it looked clearly overvalued because it had gone up 8% in a month. And so we have had a bit of correction in the short term. So this is our charts page on GoldCore, where we have charts going back 10 years and all the various time frames you could wish in the major currencies there. And so we have had a bit of a correction, and I think it's hard to know. I mean, maybe the correction has already had, but I mean, technically it still looks vulnerable of a further weakness, and we could go down to 1350, 1400 per ounce, you know, in dollar terms. And similarly in sterling and euros, you know, we could see a bit of a correction. But I think there's, you know, 50, 100, $150, euros, pounds to the downside. But meanwhile, the upside is, you're talking about hundreds of dollars, hundreds of pounds, hundreds of euros. And as we'll speak about now soon, you need to be focused not on the price, but on gold's benefit as a hedging instrument and a safe haven asset, which is the most important consideration with gold. So just in terms of the 1 year relative performance, as you can see, I mean, gold's up, top performing asset in the world in the last 12 months, you know, because palladium is a commodity. It's not really considered an asset per se. Gold is considered an asset. It's a form of money, and it's a safe haven asset. And gold is up 26.7% in dollar terms in the last year. Silver is playing catch up, 25.6%. Next best sort of major assets are the 30-year bond up 15% in the US, the 10-year note up 10%, 5-year note 6%, US dollar 5%, Japanese yen 5%, Euro stocks 3%. So you can see stocks are beginning to underperform over a 1 year basis. The DAX is actually down 1%. The Nikkei is down 8%. So Russell 2000 down 8.6%. So it's interesting. That suggests that stocks are topping out, and there is a rotation out of these overvalued assets, risk assets, stocks and bonds, which are at all-time record highs, particularly in the US. And there's a rotation into the safe haven assets of gold and silver. That's the 1 year. And then this is the year to date. So year to date, gold is in there 18.5% year to date. So very strong return. It's outperforming most assets. Similar return to the S&P 500, the leading benchmark in the world. Nikkei is obviously a little bit bubblicious, up 23% in the year, building on the massive gains of recent years. Euro stocks 18%. So again, it speaks of gold being slightly overvalued in the short term from a trading perspective, but given the degree of risk in the world in terms of macroeconomic risk, financial risk to risk assets, and then monetary risk in terms of what's going to happen to the dollar, the euro, the pound, and how they're going to be printed and electronically created in a massive way in the coming months and years. You know, in that context, they don't look that overvalued. So this is goldprice.org again, showing how gold has performed over the long term, and this is the all-important performance of gold in all currencies. It's not just gold in dollars, and gold isn't priced in dollars. The most commonly quoted price in the world is gold in dollars from the futures market, but gold is priced in the UK. Our clients buy in sterling. In the EU, our clients buy in euros. In Australia, clients buy in Australian dollars. So gold is acting as a hedge for people throughout the world, and you can see that very clearly when you look at this line here. 2019, gold is up 17.7% in dollars, in pounds 21.3%, and in euros 24.5%, because the euros start to come under pressure, you know. So again, gold is acting as a hedge against fiat currencies. And then you can see the long-term performance is actually, over the last 15 years, it's done 9.6% in dollars, 10.7% in euros, and 12.5% in sterling. So it's actually outperformed even stocks, which have performed extremely well in the last 15 years. Gold has outperformed most leading stock market indices, a fact that you haven't heard a whole lot in the media, unfortunately, in recent months and years, because they don't tend to cover gold comprehensively or accurately, whereby people know the basic facts of how gold has performed in the medium and long term. So, and I mean, you can see there's a lot of bullish developments in the gold market, including, you know, the plumbing of the U.S. financial system coming under pressure in last week and again this week, and the U.S. Treasury having to, the Fed having to print print money to buy the bonds that the US Treasury is issuing, and that is in itself is quite bullish. It suggests that there's something rotten in the state of New York and the state of the US in terms of the financial system over there, So the backdrop is very bullish. And given these risks, it's important to focus on, fade out the noise of Trump and Brexit and the stuff that's happened in the UK. I mean, the degree of financial dysfunction in the UK and the US today is just, it hasn't been seen in our lifetimes, and maybe it's never been seen potentially. So you're talking about a degree of political turmoil that has not been seen in a long, long time, and that does not bode well for either the sterling or the dollar in the medium and long term, So let's look at the reasons why. Just fade out the short-term noise and all these things that we get distracted with, and let's look at why you own gold in a portfolio. Gold is a hedging instrument and a safe haven asset. So what does that mean? Well, it basically it hedges declines in the fall of stock markets, and most of our pensions are in stock markets. It also hedges declines in the fall of bond markets, and most of our pensions, balanced portfolios, most of our wealth in the world is managed in stocks and bonds, particularly in our pensions. So gold is a hedge against that, and that's been seen in a variety of research that we have actually, amalgamated over the years. Because unfortunately the media, before the last crisis, the media used to call gold a perceived safe haven, and then the crisis happened and it quickly became an actual safe haven. There was no perceived but put before the word safe haven. But in last year or 2 years, I see perceived safe haven creeping in again, and it's nothing perceived about it. It's there in the historical record. It's there in recent history during the financial crisis, and it's also there in academic research, in independent research from asset allocation experts. It's all there, and the journalists and the editors need to do their own research and their own due diligence, and then they can report that it is an actual safe haven, akin to US Treasuries, which they say are a safe haven. And I think there could be question marks over that, given Trump has gone to $1 trillion budget deficits, and the outlook for the dollar is not great. So how the US Treasuries are a safe haven, an actual safe haven, rather than a perceived safe haven, I'm not sure. But anyway, so that's the academic research there. We have the guides on our website. If you type in GoldCore guides into Google, you'll get all the various guides we've done over the years. And that one has, it basically looks at all the various research from everyone from Mercer to Ibbotson to Wainwright Economics, and then of the academic research as well. So including from the academics here in Ireland, Dr. Brian Lucy and Dr. Konstantin Gurdjieff, who basically established that gold, it has an importance to a diversified portfolio due to its unique properties as simultaneously a hedge instrument and a safe haven. So sorry, as I was saying, a hedge instrument hedges the decline in stocks and bonds. A safe haven asset is something different. A safe haven asset is an asset that performs very well in financial crisis, in systemic crisis, when you have bank runs, when you have stock market crashes, when you have property market crashes, when you have currency collapses and hyperinflation. That's when gold comes into its own as a safe haven asset. And it's important to focus on that and focus on, as I said at the outset, gold's value, and not solely its price. Unfortunately, in modern society, we know the price of everything and the value of nothing. I don't know who said that, but it's a great expression, and it's particularly appropriate when it comes to gold and indeed silver. So that's the research there, and yeah, it's there. It's fact-based, it's empirical, and it's important people understand that, and then they are much more comfortable having that allocation to gold in their portfolio. So that's it. Yes, so short term we look a little bit overvalued, but medium long term it looks as strong as it's ever been. I think it's hard to make a more positive and more constructive case for gold, given the backdrop that we see in the world today. So I see there's again, a lot of people have talked about the price and what price will go to, and all that speculation of gold 10,000, 20,000, and someone came out with a report. I quite respect the guy. I think it was Pierre Lasson the gold industry talking about gold at 25,000 in 25 years or something like that, you know. And at the end of the day, that's all speculation. No one has a clue, you know, and none of us can say in any time frame or any amount in terms of 5,000, 3,000, 5,000, 10,000. But unfortunately, we are, to agree, forced to, because, you know, that's what people want to talk about. What price will it go to? And I suppose they ask that because they want to think about, well, their exit and when should they sell, you know. So it is understandable to a degree, and the media tends to focus more on the price rather than on the value, you know. So, and we take part in the Bloomberg Gold Survey, and we take part in the Reuters Precious Metals polls. So we have to actually, you know, look at the price and what is our outlook and all the rest. So we have said we think gold will go to over the inflation adjusted record high, which is over $2,500 to $3,000 per ounce in the coming years, and we think it's probably best just to stick with that, and then when it gets at a level we can revise it upwards, you know. So it's very, very conservative, and we've said there is a possibility of 5,000, 10,000, all the rest. And it's not that gold will be going up per se, it's that the dollar, the euro, pound will be losing value versus the real tangible asset that is physical gold, the monetary asset. And sorry, one of the most important drivers of gold in the long term is the central banks buying gold again. And it's important that I didn't say that at the outset. It's the biggest central banks in the world are buying gold. The biggest creditor nations with massive foreign exchange reserves, including massive dollar reserves, are buying gold in quite a big way. They're the biggest buyers of gold in the world. And unnoticed recently, they're quietly during the summer season, the central banks announced that they're not renewing their gold agreement, which was facilitating gold, selling gold into the marketplace over the last 20 to 30 years. So they've now said that they're not going to be selling gold in the marketplace. And as I said, some of the biggest central banks in the world are buying gold, not just the Chinese and Russians, you know, the people who are to a degree anti-American and anti-American agenda per se, but it's also the Indians, Mexicans, Filipino, central bank, Poland quite recently, Hungary, so banks even in Europe, you know. So that is a very bullish factor, and they're buying it because they know it is a safe haven asset, you know. So, but Lassonde talked about gold 25,000. Is that possible? It is possible. But again, it's not that gold's going up per se, it's that the dollar, the euro, pound are going to be losing value, you know. So when people say to me, oh, gold's overvalued in the short term, it's like, yeah, fine, that's fine if you're a hedge fund manager or you're a trader or you're a speculator, you're trying to get rich quickly, which is never advisable and doesn't tend to work out too well for people. You need to always keep a long-term view when it comes to investing and preserving and growing your wealth over the medium and long term. And gold's value is that's what it does. It's a wealth preservation asset that actually both protects and grows wealth over the medium and long term. So this is a great chart from macrotrends.net. And it shows gold in 1980 was up at over $2,200 per ounce. That's in 1980. The Dow in 1980 was at 1,000. The Dow today is at 25,000. Property prices in 1980 were probably, you know, depending on the market, they were 1/10, 1/20, 1/50th of the prices they are today. So you've had massive appreciation in all assets around the world, stocks, bonds, property. Meanwhile, gold is well below the price it was in 1980. That right there tells you gold is actually undervalued, very undervalued in medium long term. And this is it's inflation adjusted by the CPI, the Consumer Price Index in the US, you know. So you can see the recent spike up here in gold. So yeah, we could see a little correction, obviously, but I'm very confident that we are going back up here in the next year or 2 years, you know, and potentially we will go much higher if these central banks do what they are saying they're going to do in terms of quantitative easing and negative interest rates. Then there's a potential to much higher prices. And our friend in Shadow Stats, John Williams, who he calculates inflation based on the US inflation, the CPI, based on the 1980 metrics and methodology, because there's been a huge amount of funny business going on with how the governments calculate inflation. And he calculates inflation using, as I said, the 1980 criteria, and doesn't allow for all these hedonic adjustments and funny stuff where they strip out certain goods and services that have had massive inflation. And they don't strip out food and energy and the crazy things that go on with that. And he is basically saying that the real inflation adjusted gold price in 1980 was $16,500 per ounce. So when we get up there, I think it's quite likely in the long term we will get up there, you know. But again, you shouldn't be buying gold based on price predictions. You should be buying gold as a hedge and as a safe haven. And if it does get up there, it means obviously the currency has been massively devalued and debased. And this is John Williams' Shadow Stats silver price. It's $770 per ounce in 1980 if you adjust for inflation. So will it get up here? Again, I think it probably will in the medium long term. But again, you know, past performance is no guarantee of future returns, and nobody has a crystal ball, and you should not be buying these assets based on anybody's price prediction. You should be buying them because they are a hedge and a safe haven. Full stop, end of, and currencies are going to be devalued, and this is going to protect and grow your wealth. So it's just that simple, really. This is where we are today. Look at that all-time record lows. Sorry, this chart was in April 2018, but because it goes back to 1720, I think it's still quite relevant and important. And today we're at $17-18, you know. So, you know, $1,500 is actually quite conservative, you know. And similarly with gold, when you talk about gold going back up to 2,000, 3,000, it's actually quite conservative in the grand scheme of things. So it's important to always adjust for inflation. When the media talks about gold at record peaks, peak is like this. And I heard about gold record peaks in 2007 and 2008 and 2009, and it never actually peaked. It kept going to a higher peak. They never talk about stock market peaks. So perceived safe haven gold peaks. So anyway, they should talk about gold hitting nominal record highs, because if you adjust for inflation and look at real record highs, gold is, you know, this chart was June 2016. So we're up in the middle here around $1,500 per ounce. We've had a bit of a bounce, but we're still massively undervalued over the medium and long term. So hope that sort of covers the bases and sort of gives you our outlook and our worldview, you know, and people need to fade out all the noise, and there's a lot of concerning things happening in the world, but, you know, we'll come through it. The people who own physical gold and silver in the safest way possible, fully segregated, fully allocated, safest vaults in the world, safest jurisdictions in the world, those people are going to come through it very well indeed, and they'll sleep better at night. And yeah, we speak about that, how to own gold in the safe way possible, in our most recent podcast, which you can get on Apple Podcasts. That's the most recent one. There is your gold safe. We're actually recording another one now next week, which will be going out very soon indeed, and obviously you can access our podcasts on YouTube as well. So that's a wrap. Thank you for your time today. I hope I have given you some reassurance about the outlook, both short, medium, and long term. And yeah, please subscribe to our market updates on our website GoldCore.com, and to our video updates. And indeed, you can subscribe to us on all the usual social media channels. So thanks for your time. Take care. Bye-bye.